Hello friends, I'm Sanjay. In this series, I'm covering the business studies subject from the CBSE Class 12 syllabus. We will be following the standard NCERT textbook for the topics that we will discuss. This is the 10th video of this series and we will cover the 10th chapter, Financial Markets, from part B of the subject. Let us start with the concept of financial markets. We have already discussed in the previous chapters that every business needs funds or money to finance both its assets and its activities. There are two sources of funds for any business: owners or investors funds and borrowed funds. Owners or investors funds means the money brought in by the owners of the business. In a company, the owners or the investors funds will be brought in by way of equity share capital or preference share capital. Borrowed funds means the money that is borrowed by the business through loans, by issuing debentures, by accepting deposits from banks or financial institutions, or by accepting deposits from the public. What about the profits generated by the business itself? Can't it be a source of finance? Yes, it can be. But technically, the profits generated by the business belong to the owners or the investors of the business. So, profit generated by the business, which is not given out to the owners or the investors, but retained by the business itself, either as reserves or retained earnings, is also classified as owners or investors funds. Next, let us talk about the savers or the investors. Most of us are savers because we save a part of our income, which is the surplus funds left over after our expenses have been taken care of. Some people who have access to larger amounts of money may be investors. The main difference between savers and investors is the risk that they are willing to take. A saver may typically have a smaller sum of surplus funds, so they don't want to take unnecessary risks. They may invest in a bank fixed deposit, which will fetch a small amount of return. An investor may have a larger amount of funds, and they are willing to take a higher level of risk, and they may invest in shares or in debentures or in company deposits, or may even give out loans to various businesses. The higher the risk that the person is willing to take, the higher the returns that may be expected. Now, you have businesses which need money, and you have the savers and the investors who need to invest their money and earn returns. This is where the financial markets come in. They are the medium that connect the savers, the investors, the banks or the financial institutions, and the businesses. Financial markets allocate or direct the savers or the investors' funds into the most productive investment opportunities. Here, banks and financial institutions are both financial markets and they are also investors. As financial markets, they collect deposits from savers and provide loans to businesses which need money. So, banks perform an allocative function. As investors, banks may invest in various companies as shareholders, which is why some banks are also called investment banks. In a perfect world where everyone has perfect information and takes perfect decisions, the financial markets can perform perfect allocative function, where savers and investors get the highest possible rate of returns for their money, and the financial resources are allocated to the most productive businesses. But in reality, perfect allocative function is very, very rare. Banks and financial markets, which collect the funds from the savers and the investors and provide it to businesses, perform the allocation of funds. This allocative function is also known as financial intermediation. So, banks and financial markets are called financial intermediaries. As a saver, you have a choice of either investing your money in a bank fixed deposit, or you can go through the financial market and directly invest in a business for higher returns, of course at a higher risk. If you deposit your money in a bank, the bank will give you 7% interest and give that money as a loan to a business at say 13% interest. And the difference is the bank's profit. The businesses which are participating in the financial market want you to bypass the bank and directly invest with them as a shareholder or a debenture holder or as a depositor. in which case they will have access to funds at a cheaper rate than through a bank loan. You as the investor will earn a higher rate of return than through a bank deposit because you are taking a greater risk. So here the banks and the financial markets are competitors or competing intermediaries because both are competing to attract your money. A point to remember here is this term financial market is a generic term. Any platform or any process which connects savers, investors, banks, financial institutions and the businesses is a part of the financial market. A definition of the term financial market is that it is a market for the creation and exchange of financial assets such as shares, debentures and bonds. Here there are two processes, the creation of financial assets and the exchange of financial assets. Creation is the initial issue of financial assets from the business or the government to the original buyers or the original investors. And exchange is the subsequent sale, purchase or exchange of financial assets. For example, a company like Bajaj Housing Finance announces an IPO or an initial public offering for its shares. A large number of people apply, but only a few people get the IPO allotment. Here the company has created the financial assets, which are its shares, and allotted them to the original buyers or the original investors. So this is the creation process. After the allotment, the shares are listed in a stock exchange. And because there are so many more people who are interested in buying the shares, but did not get the original allotment, there is a huge demand in the market. And the prices of the shares which are listed on the stock exchange quickly increase. The original allottees sell their shares at a profit and other investors can buy those shares. This is the exchange process. Later, these new buyers may again sell their shares and others will buy them. So this buying and selling, that is the exchange, can happen indefinitely. The creation, that is the IPO and the original allotment happens only once. And this happens in the primary market. And the subsequent selling and buying can happen many times, and this happens in the secondary market. Similarly, the government may auction treasury bills, which are issued when the government wants to borrow money or take money from the market. Or another example can be sovereign gold bonds, which have been issued by the government many times. These auctions or issues of bonds are the creation process. And these are said to be happening in the primary market. Later on, the institutions which got the allotment of the treasury bills or the persons who purchased the sovereign gold bonds may sell them to others. So all these subsequent sales and resales are called exchange, and these are said to be happening in the secondary market. So now you know what is the process of creation, what is exchange, what is the primary market, and what is the secondary market. The term financial markets includes all those markets where different types of financial products are bought, sold or exchanged, such as the capital market where equity and some debt instruments like corporate bonds and debentures are issued and existing securities are traded among investors. The Bombay Stock Exchange and the National Stock Exchange are good examples of capital markets. There is the money market, which deals with short-term borrowing and lending, especially for periods less than 1 year. Instruments in the money market include treasury bills, commercial paper, certificates of deposit, and repurchase agreements or repo. Then there is the debt market for short-term and long-term bonds with a maturity or a tenure of more than 1 year. And there are markets for derivatives, forex or foreign exchange, commodities, insurance and reinsurance related products, mutual funds, private equity and venture capital, and also non-banking financial companies or NBFCs, which provide various banking-like services without meeting the legal definition of a bank. But in the CBSE Class 12 syllabus, we will be discussing only about the capital markets and the money markets. And maybe we'll briefly touch upon even the debt markets. What are the functions of financial markets? There are four main functions: mobilization of savings and channeling them into the most productive uses, facilitating price discovery, providing liquidity to financial assets, and reducing the cost of transactions. The first one, mobilization of savings and channeling them into the most productive users, means that the financial markets facilitate the transfer of savings from the savers to the investors, and also from the savers and investors to the businesses, because ultimately it is the businesses which need the funds. The markets offer savers and investors a variety of saving and investment choices, and the markets channel surplus funds into the most productive uses. For example, if you keep all of your money in cash in a safe deposit locker, then the money is not generating any returns, and it is not helping in the economy as well. But if you put the money in an FD, then it generates returns for you, and the bank will give the money as a loan to a business which needs the money. So the surplus funds are being put into a productive use. The second one, facilitating price discovery. Suppose I have 10 Infosys shares with a face value of 10 rupees each. What is the current market value of these shares? Now the demand and the supply of Infosys shares in the financial market, that is the stock market, will help me discover the current price of these shares. Similarly, when there is an interaction between the people who have money and the businesses who want money, the value of various financial assets like bonds or debentures can be discovered. The third one is providing liquidity to financial assets. If I have Infosys shares and I need money urgently, then the financial markets provide the liquidity, because I can sell these shares in the stock market and convert them into cash. The various types of financial markets like the bond markets, the forex markets, the debt market allow for the sale or the purchase of different types of financial assets, and therefore they provide liquidity. The fourth one is reducing the cost of transactions. There are specific processes for the sale and the purchase of various securities in the financial markets. The fees, the commissions, the brokerage and other expenses are usually regulated. So the overall cost of transactions is controlled and reduced. Also, the markets allow useful information about various financial securities to be collected, analyzed and used by both the buyers and the sellers. And also by serving as a common platform for the buyers and the sellers, the financial markets save the time, the effort and also money for all the participating parties. Next, let us talk about the classification of financial markets. As I have previously mentioned, there are different types of markets which come under the generic term financial markets. There are capital markets, money markets, debt, derivatives, forex, commodity and other markets where specific types of financial instruments are bought, sold or exchanged. In the syllabus, we will be talking about the money market and the capital market. The money market deals with financial instruments with a maturity of less than 1 year. The capital market deals with instruments like equity shares, which have no defined maturity, and with bonds and debentures, which are debt, with a maturity of more than 1 year. Capital markets are divided into primary markets and secondary markets. Primary markets are where the initial public offerings of the shares of various companies are made, or where the bonds or the debentures are originally issued. This is where the creation of financial securities takes place. The people who got the original allotment of the equity shares and those who originally bought the bonds or the debentures in the primary markets may thereafter sell them or exchange them in the secondary markets. And this is where the exchange of financial securities takes place. Let us talk about money markets in a little more detail. Money market is a market for short-term funds. It deals with monetary assets or financial securities with a maturity period of up to 1 year. These assets are close substitutes for money because they can be quickly converted or traded for money and can be converted into cash. Trades in the money market are generally low risk, they are unsecured, and these short-term debt instruments are highly liquid, which again means that they can be easily converted into cash. There is no specific physical location for money markets. unlike a specific stock exchange. And the activities of the money market are usually conducted over the telephone or through the internet. And there is active daily trading of these financial instruments in the money market. The money market helps in raising short-term funds. They help entities in meeting temporary shortages of cash and fulfill obligations, such as working capital requirements or to take care of any urgent payments, etc. The money markets facilitate the deployment of excess funds. For example, if you have some extra funds, or if a company has some unused funds, which will be required only after a few months. The money market allows for the temporary investment of these surplus funds to earn some returns. The major participants in the money market are the Reserve Bank of India or RBI, various commercial banks, non-banking financial companies or NBFCs, various state governments, large corporate houses, and mutual funds. The term capital market refers to the facilities and the institutional arrangements through which long-term funds, both debt and equity, are raised and invested, that is, issued, bought, and sold. Coming to the functions and characteristics of capital markets, they make the savings of the community available for various business enterprises, as well as the public in general. They direct these savings of the communities into their most productive uses, leading to the overall economic growth and the development of the country. The term capital market includes development banks, commercial banks, and most importantly, stock exchanges. Now, what is the importance of an ideal capital market? Well, these markets make finance available at reasonable costs to those businesses which need the money. By making the finance available at reasonable costs, they facilitate the process of economic development through a well-functioning capital market. Because development of an efficient financial system is seen as a necessary condition for the economic growth of any country. Now, what are the essential features for the efficiency of capital markets? First of all, the financial institutions should be sufficiently developed. The market operations must be free, fair, competitive, and transparent. And they should deliver efficient information. They should minimize transaction costs, and they should allocate capital most productively. Here I have given a table that gives us a quick comparison of capital markets and money markets. Financial institutions and banks, corporate entities, foreign investors, and ordinary retail investors from the public are the main participants in capital markets. Institutional participants such as the RBI and banks, financial institutions, and finance companies are the normal participants in the money markets. Individual investors typically do not participate in the money markets because the amounts involved here are usually quite large. Equity shares, debentures, bonds, and preference shares are the instruments which are traded in the capital markets. And short-term debt instruments like treasury bills, trade bills, repurchase agreements or repos, commercial paper, and certificates of deposit are traded in the money market. Capital markets are typically accessible to individuals with small savings because they can buy one share or two shares or any small number, which means that large sums of money are usually not required, unless of course you are buying some very expensive shares. But in money markets, the transactions entail huge sums of money and the instruments are quite expensive, like crores of rupees. So normal individual investors are usually not present in this market. Capital market instruments like equity shares have no specific duration, and others like debentures have a maturity or an investment duration stretching across many years. Whereas the instruments in the money market have shorter tenures, maximum of up to 1 year, and sometimes the tenure or the maturity can be as short as a single day. The instruments in the capital markets have a reasonable level of liquidity. They are normally marketable on the stock exchanges. However, in some situations, especially if the share is not being actively traded, then finding a buyer can become difficult. But money market instruments are highly liquid, especially because they usually have some formal clause or an arrangement that guarantees liquidity. And also there is an organization called the Discount and Finance House of India, that is DFHI, which was set up by the Reserve Bank of India, which provides a ready market for money market instruments. In terms of safety, capital market investments are considered riskier in terms of both the returns and the principal repayment, because the issuing companies may fail to perform as projected, so the value of the shares or the price of the shares goes down. Or there is also a possibility of the promoters defrauding the investors. But money market instruments are much safer because, first of all, the shorter investment duration reduces the risk, and the issuers are usually financially sound entities like the government, banks, and highly rated companies, which minimizes the risk of default. Capital market investments may have higher returns because of the capital gains on the equity shares, the dividends, and the bonus shares. The investors here are taking a higher risk, so the returns may also be higher. In the money market, the returns are lower and usually guaranteed, such as a specific percentage of interest. The focus here in the money markets is on safety and liquidity. So, money markets are suitable for short-term investments of surplus funds. What are primary markets and secondary markets? I have already explained the concepts earlier, and here are some more points that you can memorize and use in your short and long answers. Primary market is also known as the new issues market because it deals with new securities being issued for the first time. For example, when a company makes an IPO, that is an initial public offering of its shares, or issues debentures or bonds, the transactions are considered to be happening in the primary market. The primary market facilitates the transfer of investable funds from the savers or the investors to the entrepreneurs or the businesses. For example, when investors apply for an IPO, the company gets the money. After that, whenever these securities are sold and resold, the transactions are happening between investor to investor, and they are happening in the secondary market. And the company does not get any more money from these secondary market transactions. Primary markets help in establishing new enterprises or expanding existing ones through the issuance of securities, because they make money available to the businesses or to the entrepreneurs to set up new enterprises or expanding existing ones. The investors involved in the primary markets include banks, financial institutions, insurance companies, mutual funds, and individuals, that is the general public. The forms of capital raised in the primary market are equity shares, preference shares, debentures, loans, and deposits. And the purpose of raising funds in the primary markets might be for setting up new projects, expansion, diversification, modernization, mergers, and takeovers. After securities are issued in the primary markets, they can be bought and sold in the secondary markets. This is why the secondary market is also known as the stock market or the stock exchange. It is the marketplace for the purchase and sale of existing securities, helping investors disinvest and allowing new investors to enter the market. This means that investors who acquired the shares or the securities in the primary market can exit by selling them in the secondary markets, and new investors can buy these securities and enter the market. The secondary market provides liquidity and marketability for existing securities, allowing them to be easily converted into cash. Secondary markets contribute to economic growth by funding the most productive investments through divestment and reinvestment, which means that the money keeps flowing through the markets. As a regulatory authority, the Securities and Exchange Board of India, SEBI, controls and oversees secondary markets to ensure transparency and fairness. So the secondary market enables the sale and subsequent purchase of shares and securities, all within the regulatory framework provided by SEBI. Additionally, advancements in information technology and internet have made stock exchanges accessible from anywhere in the country, enabling people from across India to participate in economic activities. And over the last few decades, along with the growth of the primary market, the secondary market has played a significant role in diversifying the investment opportunities for people across the country and generating wealth for investors from across India. This table provides a quick comparison between primary and secondary markets. Since we have already covered all of these points in detail, I won't go into each one. but you can refer to this table for your revision. The primary market is also known as the new issue market, while the secondary market is commonly referred to as the stock exchange. In the primary market, new securities are issued and sold directly to investors, whereas in the secondary market, trading of existing securities takes place between investors without the company being involved. In the primary market, funds flow from the investors to companies, promoting capital formation. In contrast, the secondary market provides liquidity to securities which were originally issued in the primary market, allowing investors to convert their holdings into cash. In the primary market, only buying occurs because the securities are only issued by the companies and bought by the savers or the investors. However, in the secondary market, both buying and selling of securities takes place. Price determination in the primary market is set by the issuing company, while in the secondary market, prices fluctuate based on supply and demand. The primary market does not have a fixed location because transactions can occur over the phone or over the internet. In contrast, in the secondary market, there are specific physical locations such as the official exchanges like the Bombay Stock Exchange or the National Stock Exchange. Of course, these might not be physical locations, but still there are specific websites where the transactions happen. So we can consider that they have specific locations. Next, let us understand what a stock exchange is. Stocks, also known as shares or equity, represent ownership in a company. When individuals purchase stocks, they acquire a small portion of the company, which entitles them to a share of its assets and its profits. A stock exchange is a platform where investors can buy and sell securities, such as shares, stocks, and bonds. And this is done through brokers, who execute the trades on behalf of the investors. So, stocks are exchanged at specific regulated locations, known as stock exchanges. If we look at the process of how an initial public offering or an IPO works, it starts when a company offers its shares to the public for the first time. Many investors may apply, but only a limited number of shares are allotted. After the IPO, the shares get listed on a stock exchange like the Bombay Stock Exchange or the National Stock Exchange. Once they are listed, the transactions can take place between the original shareholders and the new investors. Later, these new investors can also sell their shares to others, creating a continuous cycle of buying and selling, which all happens within the stock exchange or the secondary market. Prominent exchanges in India include the BST, known for its Sensex index, and the NSE, which is known for its Nifty index. Other exchanges like the Indian Commodity Exchange also exist, catering to specific types of securities and commodities. What are the important functions of the stock exchange? First of all, providing liquidity and marketability to existing securities. What does this mean? Basically, the stock exchange creates a continuous market where people can buy and sell securities anytime. So, if you want to cash out on your investment or reinvest in something else, you can do it easily. It's like a marketplace that keeps things moving and ensures that your securities or your money doesn't get stuck. Next, pricing of securities. Suppose you have TCS shares and the face value of each share is 10 rupees. How do you know what is the share actually worth as of today? On the stock exchange, prices are driven by demand and supply. If more people want to buy a stock, then the price goes up. If more people want to sell, then the price drops. So it is a live pricing mechanism. It gives both the buyers and sellers up-to-date information at any given moment on what is the value of their shares. Then there is safety of transactions. Stock exchanges are tightly regulated with strict membership rules. So when you are trading, you can be confident that you are getting a fair and a safe deal, thanks to the transparency and the legal framework that governs these transactions. Now let us talk about the bigger picture, contributing to economic growth. By allowing existing securities to be sold and resold and traded, the stock exchanges help channel savings into more productive investments. This reinvestment drives capital formation, which ultimately fuels economic growth. Next, spreading of equity culture. Now, stock exchanges don't just facilitate trading. They also play a huge role in educating the general public about investments. So they promote wider share ownership and ensure that new issues get well regulated. Basically, these stock exchanges are encouraging more people to get involved in the markets and generating wealth for people from across the country. And lastly, let us not forget providing scope for speculation. Speculation sounds risky, but in a controlled manner, it is actually necessary. And the stock exchange allows for a certain level of healthy speculation to ensure liquidity and price stability in the market. But of course, this speculation is also tightly regulated by various laws and rules. Next, let us look at the trading and settlement process in stock exchanges, which is how stock exchanges actually work. Once upon a time, when stock exchanges were still new and not tech driven, buying and selling of shares happened right on the stock exchange floor. Back then, there was something called the open outcry system or the auction system. Imagine a chaotic room filled with lots of brokers taking orders from their clients, then shouting out the prices that they wanted to buy or sell the shares at. Other brokers would respond by shouting back with their own prices, either accepting or proposing new prices. It was very loud, fast-paced and intense. But fast forward to today and it is a completely different scene. The trading has moved from the noisy exchange floor to the calm and quiet of a broker's office or onto your own desktop. Now everything is done through an online screen-based electronic trading system. All the buying and selling of shares and debentures is managed through computer terminals that are directly connected to the main stock exchange servers. So no more shouting, just clicks and numbers on a screen. Let us break down the trading and settlement process in the stock market using this simple flowchart. Imagine you have a buyer on one side and a seller on the other side. Individuals cannot directly trade on the stock exchanges, and all trading is done through registered brokers who are connected to the stock exchange. So we have broker 1 for the buyer and broker 2 for the seller. The buyer places an order to buy shares through broker 1, and this order goes to the stock exchange. The stock exchange then matches this order with a selling order from broker 2 and connects the buyer and the seller. Once the trade is confirmed, the buyer's money flows from the buyer's account to broker 1's account and then to the clearinghouse and from there to broker 2's account, who then sends it to the seller's bank account. The shares move in the opposite direction, from the seller's Demat account to the broker 2's Demat account. From there, it goes to the clearinghouse and the depository, then to the broker 1's Demat account, and finally to the buyer's Demat account. Clearinghouses are like middlemen who make sure that the buyer gets the shares and the seller gets their money. Examples include the Indian Clearing Corporation and the NSE Clearing Limited. Depositories are like banks for your shares. All Demat accounts are actually opened in a depository. The two main depositories in India are CSDL, that is Central Depository Services Limited, and NSDL, National Securities Depository Limited. The depositories are constantly connected to the clearinghouses. Active stock exchanges in India, where all this trading happens, include the Bombay Stock Exchange or BSE, known for the Sensex, NSE or National Stock Exchange, known for the Nifty Index. There are some other exchanges also, like the Calcutta Stock Exchange, Multi Commodity Exchange, and many more. But they are either specialized exchanges for specific types of securities, or they are very small. And to trade on these exchanges, you will need a broker. Some of the top brokers include Zerodha, Upstocks, ICICI Direct, HDFC Securities, Angel Broking, and many more. So this is a quick overview of how money and shares flow in the stock market and who are the main players. Just to add, this flowchart is a simplistic version. There are many more steps and there are more links in the full process. But for the purpose of this discussion, I have tried to keep it simple. These days, almost everyone uses an online platform to trade in the stock market. And here is how the process actually works. Customers log into their broker's platform like ICICI Direct, Zerodha or any other. and enter the details about the shares that they want to buy or sell, including the price at which they want to make the trade. The broker's platform is linked to the stock exchange's trading system. Now the software in the stock exchange is designed to automatically execute the trade when a matching order is found. Basically, if there is a buyer for a specific quantity at a specific price, then there has to be a seller willing to sell at the same price for the transaction to happen. Both the buyers and sellers can see the prices of all shares fluctuating in real time during trading hours. The system continuously matches buy and sell orders at the best possible bid and offer prices. So every time there is a match, the trade is executed instantly. Any unmatched orders will remain open in the system till the end of the trading day, before they either expire or they are withdrawn. The money flow happens from the buyer's account to the buyer's broker's account, to the clearinghouse, to the seller's broker's account, and then to the seller. The flow of shares happens from the seller's Demat account to the seller's broker's Demat account, and then to the clearinghouse and the depository, then to the buyer's broker's Demat account, and then to the buyer's Demat account. Since all the buying and selling is happening in an electronic format, even the shares have to be available in an electronic format. And this is called dematerialized shares. Shares in material forms means physical paper share certificates. And Demat shares are in electronic form, held in your Demat account. The textbook next talks about the steps involved in using screen-based trading for buying and selling securities. There are 10 steps listed in the textbook, but that is because one of the steps has been divided into two, causing a little confusion. To understand the process better, you just need to remember these 9 steps. It starts with the selection of the broker and the agreement with the broker. Then opening Demat and bank accounts, then placing an order, matching of the order, execution of the order, issue of contract note, settlement which happens on pay in day, and settlement which happens on the pay out day or T+2. And finally, delivery of the shares. I will briefly talk about each of these steps in the next few slides. The first step is the selection of the broker and the agreement with the broker. The investor approaches a registered broker such as ICICI Direct or a sub-broker and enters into an agreement. This agreement is a broker-client agreement, and a client registration form also needs to be filled at this time. In that form, the investor provides necessary details and information, including the income tax PAN number, which is mandatory, date of birth, address, educational qualification, occupation, residential status, that is, whether the investor is an Indian or an NRI, bank account details, depository account details, that is, if the investor already has a depository account, the name of any other broker with whom the investor is already registered, and the client code number with the other broker. In short, these are all the KYC or Know Your Customer details, which includes the ID proofs, the address proofs, and the tax details. If all the details are okay, then the broker opens a trading account in the name of the investor. If the investor does not already have a Demat account and a bank account which can be used for the trading, then the investor will have to open a Demat account through the broker itself and a suitable bank account. Then comes placing an order. The investor places an order with the broker to buy or to sell shares. The investor provides clear instructions about the number of shares and the price at which the shares should be bought or sold. The broker issues an order confirmation slip to the investor, acknowledging all the details that have been provided by the investor. Based on the order details, the next step is matching of the order. The broker or the broker system connects to the main stock exchange to match the buy or the sell order and the best price available in the market. Next comes the execution of the order. When the shares can be bought or sold at the price that the investor has mentioned, then it is communicated to the broker system and the order is executed electronically. The broker then issues a trade confirmation slip to the investor. Next is the issue of the contract note. After the trade is executed, within 24 hours, the broker issues a contract note to the investor. The contract note contains all such details such as the number of shares bought or sold, the price, the date, the time of the deal, the brokerage charges, etc. This is a very important legal document which is legally enforceable because it is like a contract and it helps settle any disputes or claims between the investor and the broker. When trades are confirmed on the stock exchange platform, a unique order code number is also assigned to each transaction by the stock exchange system, and this number is also printed on the contract note, and this can be used to track the order on the stock exchange platform. Next, there is the pay-in day, when the first settlement has to happen. This is the day when the buyer pays in the money to his broker and the seller delivers the shares to his broker's account. This pay-in on the initial settlement happens before the next settlement day on T+2 because the money and the shares are required to be in the respective broker's accounts for the stock exchange system to proceed to the next step, which is the settlement payout day on T+2. T+2 means transaction plus 2 business days. On the T+2 day, the exchange delivers the shares and makes payment to the buyers and the sellers' brokers respectively. This is called the payout day. The seller's broker then makes the payment to the seller within 24 hours of the payout day, since he would have received the payment from the exchange. The last step is the delivery of the shares to the buyer. The buyer's broker has already received the shares into his Demat account from the stock exchange on T+2 day. So, if the buyer's broker does not already have all the required details, the investor provides the details of their Demat account and instructs their depository participant to take delivery of the securities directly into their beneficial owner account or the Demat account. The buyer's broker can then deliver the shares in Demat form to the investor's Demat account. A point to remember here is that the brokers, the depository participants, the banks, the stock exchanges, the clearinghouse and the depositories are all tightly connected. So the entire series of steps that we just discussed happen quite seamlessly. Sometimes some of these players may even belong to the same group, like you may use an ICICI direct account, which is both your broker and is also your depository participant, and it is connected to your ICICI bank account. So the process may get even more simplified. What are the advantages of electronic trading systems or screen-based trading? The first one is transparency. Stock exchanges ensure complete transparency by allowing everyone to see the prices of all securities in real time. So whether you are a buyer or a seller, you can see what is happening in the market, even as trades are being made. This openness, this transparency helps build trust and makes trading fair. Next is efficient information flow. Thanks to technology, information on prices and market developments is instantly available to everyone. This helps in setting prices correctly and ensures that everyone is on the same page, which is crucial or important for making informed investment decisions. Operational efficiency. Modern exchanges reduce the time, the cost and the risk involved in transactions. Moreover, automated systems minimize human errors, making the whole trading process faster and more reliable. Then there is accessibility, because no matter where you are in the country or even if you are abroad, you can easily participate in the stock market. With the online platforms, anyone can trade without needing to be physically present, making it more accessible to a larger audience. And finally, single trading platform, which means that all the trading happening across the country is now centralized on a single trading platform of that stock exchange. This means that every transaction happens in sync, ensuring smooth operations and unified access for all investors from all corners of the nation. Next, let us understand what are dematerialization, depository participants and depositories, and what is the connection between them. Once upon a time, all money was in physical format, in the form of currency notes or in the form of coins. Then we started moving towards electronic money. Here the money is in electronic format, in your bank accounts. Because it is in an electronic format, you can also spend, save or transfer the money electronically through an app or through a website. Similarly, once upon a time, all shares were issued in a physical format and they were also held in a physical format as share certificates. When the financial markets and the stock markets started to move towards electronic trading platforms, it made sense to convert the shares from a physical paper format or a material format to an electronic format. This process of converting material shares to electronic formats is called dematerialization. Why was this required? basically because of the shift to electronic trading, where all trading in securities is now conducted through computer terminals, and the buying and selling of securities are settled through an electronic book entry. What happens during dematerialization? The securities held by the investors in a physical form are cancelled, and the investors receive an electronic entry holding securities in an electronic balance in a Demat account. Demat account means dematerialized account. What are some of the other purposes or the other benefits of dematerialization? It helps in eliminating problems associated with physical shares, such as theft of the documents, creation of fake or forged transfers, delays in transfers due to having to move around the physical documents, and also the extensive paperwork associated with the buying and selling or the exchange of physical shares. Once the shares are dematerialized, they can be held in a Demat account. So, how can we open a Demat account? Investors must open a Demat account with a depository participant to hold and transfer securities electronically. A depository participant (DP) is a registered intermediary between investors and a depository in India. When you register for a Demat account with a depository participant, the actual Demat account will be opened in a depository with which the depository participant is associated. There are two depositories for equity shares, NSDL, which is National Securities Depository Limited, and CDSL, that is Central Depository Services Limited. There are more than 250 depository participants like ICICI Securities, Access Securities, HDFC Securities, etc. When a Demat account is opened with a depository participant like ICICI Securities, it is actually registered with either NSDL or with CDSL. The current practices are that all initial public offerings, that is IPOs, are now issued only in dematerialized or Demat form. And over 99% of the turnover in the share markets is settled through delivery in Demat form. There are also some regulatory requirements here. The Securities and Exchange Board of India, that is SEBI, has made it mandatory for settlement procedures to occur only in Demat form for certain selected securities. And as a major step to promote Demat holdings and ensure transparency, the transfer of physical shares was stopped effective from 5th of December of 2018. If you are asked to write about depository participants, these are the important points. Depository participants act as intermediaries between the investors and the depositories. The depositories being NSDL or CDSL. The depository participants are authorized to maintain accounts of dematerialized shares. And the entities which are permitted to become DPs include financial institutions, banks, clearing corporations, stockbrokers, and non-banking finance corporations. The key benefits provided by depository participants through Demat accounts are that no physical share certificates are involved because all holdings are electronic. And this ensures greater speed and greater efficiency in settling transactions. There is also enhanced security by reducing the risks of loss, theft, or forgery of the share certificates, because the electronic documents are safer than the physical documents. And there is also increased ease of access and ease of management of securities for the investors, who can just log into their accounts to manage them. If you have to write about depositories, then these are the important points. A depository is similar to a bank, but for securities instead of money. It holds securities in an electronic form on behalf of the investors. Investors can open a securities Demat account with a depository, but this is normally done through a depository participant or through a broker. Shares can be deposited, withdrawn, or sold at any time by accessing these Demat accounts. Investors can instruct the depository to deliver or to receive shares on their behalf. A depository operates as a technology-driven electronic storage system for electronic securities. Depositories eliminate the paperwork related to share certificates, transfers, and various other forms. And the transactions are settled with greater speed and greater efficiency using a book entry mode. There are two depositories in India, the NSDL, which is the National Securities Depository Limited, and CDSL, that is Central Depository Services Limited. NSDL is the first and the largest depository currently operational in India. It was promoted as a JV or a joint venture by the National Stock Exchange and the Industrial Development Bank of India or IDBI, and also the Unit Trust of India UTI. The Central Depository Services Limited, that is CDSL, was the second depository to commence operations in India, and it is a little smaller than NSDL. And CDSL was promoted by the Bombay Stock Exchange and the Bank of India. What are the advantages of holding shares in Demat form? First is convenience, because holding shares is similar to maintaining an electronic bank account. Conversion flexibility, because physical shares can be converted into electronic form, which is dematerialization, or if required, the electronic holdings can be reconverted into physical certificates, which is called rematerialization. There is ease of transfer, because shares can be transferred to another account just like electronic cash. Demat accounts ensure settlement of all trades through a single account, because wherever you are trading with any securities, you can just provide your Demat account. And Demat securities can be pledged or hypothecated to obtain loans. And they also improve security, because Demat accounts eliminate the risk of loss, theft or forgery of share certificates. Next, let us look at the working of the Demat system, or some of the processes associated with the Demat system. First of all, you need to select a depository participant or a DP, which can be a bank, a broker or a financial services company. Then you open a Demat account, where you complete the account opening form and submit the required documentation, which includes your PAN card details, your photograph and a power of attorney if applicable. Here KYC is mandatory in terms of your ID and address proofs. If you wish to dematerialize some physical shares that you have, then you need to submit those physical certificates for dematerialization. Here you provide your physical share certificates to the DP and fill out and submit a dematerialization request form along with the certificates. The DP will then convert the physical shares into electronic format and credit them into your Demat account. If you are applying for shares in a IPO, that is an initial public offering, you need to provide your DP and Demat account details when you are applying for shares. Upon allotment, the shares will be automatically credited to your Demat account. If you are selling shares through a broker, you instruct your DP to debit your Demat account by the number of shares you wish to sell and authorize the transfer of those shares to the broker. The broker's DP account, the broker's Demat account, acts as an intermediary during the sale and purchase of stocks. Because if you are a seller, the broker instructs their own DP to deliver the shares from their Demat account to the stock exchange on your behalf. And if you are a buyer, the broker receives shares from the stock exchange into their own Demat account on your behalf, and then they transfer the shares into the buyer's account. Next, let us talk about the Securities and Exchange Board of India, SEBI, which is a very important topic in this chapter. SEBI was founded by the Government of India on 12th of April of 1988 as an interim administrative body. This was aimed to promote orderly and healthy growth of the securities market and to protect investors. Initially, it functioned under the administrative control of the Ministry of Finance. Later, it was granted a permanent statutory status on 30th January of 1992 through an ordinance. The ordinance was later replaced by the Securities and Exchange Board of India Act of 1992, which is the current act or the current law that governs the working of SEBI and explains what are the responsibilities and the powers of this organization. What are the objectives of SEBI? First of all, to protect the interests of investors, which is to safeguard the rights and interests, especially of individual investors, and also to guide and educate investors. Promote development of the securities market by regulating stock exchanges and the securities industry for orderly functioning. Prevent trading malpractices, and this is done by achieving a balance between self-regulation by the securities industry and statutory regulation. And to develop a code of conduct for intermediaries, which is to regulate and promote fair practices among brokers, merchant bankers, etc. And also make intermediaries in the financial markets competitive and professional. What were the reasons for the establishment of the Securities and Exchange Board of India or SEBI? In the 1980s, the Indian capital market saw rapid growth. There was a huge rise in public participation and the investor base expanded significantly, leading to a sharp increase in market capitalization. In other words, there was a huge boom in the stock market. But this boom had its own downsides. There were several issues and malpractices that occurred during this period. Self-styled merchant bankers emerged and they conducted unofficial private placements. Price rigging and unofficial premiums on new issues became common. Many companies were not adhering to or not following the provisions of the Companies Act. And there were frequent violations of stock exchange rules and listing requirements. And investors faced delays in the delivery of the shares that they had purchased. So all these malpractices led to serious erosion of investor confidence. The complaints and the grievances from investors increased, but the existing regulatory framework was weak. The government and the stock exchanges did not have the power to properly penalize the wrongdoers or to properly address these issues. This highlighted the need for a strong and independent regulatory body to protect investors and to regulate the securities markets. That's when the Securities and Exchange Board of India, that is SEBI, was established as a separate regulatory authority to bring transparency, fairness and accountability to the securities market. Next, let us talk about the purpose and the role of SEBI. The primary goal of SEBI is to create a facilitative environment for the securities market. In other words, SEBI helps in ensuring that the markets run smoothly, resources are allocated efficiently, and innovation is encouraged. To do this, SEBI establishes clear rules, regulations, and policy frameworks that everyone must follow. Next, catering to market constituents. Here, SEBI has to balance the needs of the three main players, which are companies, investors, and intermediaries. Starting with the issuers of securities, which is companies. SEBI provides companies a fair and efficient platform to raise funds. It makes sure that companies can access the capital markets easily, without unnecessary hurdles. Coming to investors, SEBI's top priority is to protect the rights and the interests of the investors. It ensures that all information is disclosed clearly and accurately so that investors can make informed decisions. Coming to market intermediaries, these include the brokers, the depository participants, the depositories, the financial institutions, and all other players in the financial markets. SEBI works to maintain a competitive and professional market environment. It also ensures that there is solid infrastructure in place so that the intermediaries can offer top-notch services. So, in short, SEBI is like the guardian of the Indian securities market, making sure that everyone plays by the rules while fostering a safe and dynamic environment for growth and investment. What are the primary functions of SEBI? There are three primary functions: regulatory, development, and protective. Let us start with the regulatory functions of SEBI. Registration of market participants. Here, SEBI makes sure that everyone who is part of the market is registered. This includes brokers, sub-brokers, and other players in the securities market, and also collective investment schemes and mutual funds. Basically, if you want to be involved in the securities market in India, you need SEBI's approval. Regulation of intermediaries and markets. SEBI also keeps an eye on intermediaries like stockbrokers, underwriters, and merchant bankers. It regulates how business is conducted in the stock exchanges and other securities markets to ensure fair practices. Regulation of takeover bids. When companies plan takeovers, that is, when one company tries to acquire another, SEBI steps in to regulate these bids and make sure that they are transparent and that the investors are treated fairly. Information gathering and enforcement. SEBI conducts inspections, inquiries, and audits of stock exchanges and market intermediaries to gather information, and it enforces rules. It is a way of keeping everyone in check to make sure that the regulations are being followed. Levying fees and charges. To carry out its regulatory functions, SEBI is authorized to levy fees and charges on market participants. This helps to fund SEBI's activities and ensures smooth operations. Exercise of powers delegated by the government. Finally, SEBI has some powers delegated by the government under various acts like the Securities Contracts Regulation Act of 1956 and even the SEBI Act. This allows it to manage and regulate the securities market in India. So these are the regulatory functions of SEBI. SEBI doesn't just regulate the markets, it also plays a big role in developing them. Let us break down SEBI's development functions. The first one is training of intermediaries. SEBI organizes training sessions to enhance the skills and the knowledge of all the market participants, be it brokers, analysts, or other market intermediaries. This helps in creating a more professional and a more efficient market environment. The second one is conducting research and publishing information. SEBI conducts research and regularly publishes valuable information for the benefit of all the market participants. By sharing these insights and the data, SEBI ensures that everyone has access to the information that they need to make informed decisions. The third one is promoting the development of capital markets. SEBI adopts a flexible and adaptive approach to promote the growth of capital markets. This means introducing new policies, adopting global best practices, and encouraging new financial products, all aimed at making the market more dynamic and more investor friendly. So, SEBI's development functions are all about building up the market, making it stronger and more professional for everyone involved. Coming to the protective functions of SEBI, there are 4 protective functions. The first one is prohibition of fraudulent and unfair trade practices. SEBI actively works to prevent any kind of fraudulent activities. They can be misleading statements or even price manipulations in the market. This means no false promises, no price rigging, and definitely no unfair practices that could harm the investors. The second one is controlling insider trading. Insider trading is when someone with confidential information about a company tries to make unfair profits by using that information and trading its shares. SEBI keeps a close watch on the market and imposes penalties on anyone who is caught using insider information. This is done to maintain a level playing field. The third one is investor protection measures. SEBI has several measures in place to protect the interests of the investors. It might be ensuring proper disclosures, transparent communication, or taking action against wrongdoers. SEBI's focus is always on keeping the investors safe. The fourth one is promotion of fair practices and code of conduct. Lastly, SEBI promotes fair practices and a strict code of conduct for everyone involved in the financial markets. It sets the standards to ensure ethical behavior and professionalism, making the market trustworthy and reliable. So, SEBI's protective functions are all about keeping the market clean, transparent, and safe for everyone. With that, we can conclude this chapter. If you have any questions or feedback, post a comment below. I will see you soon in the next video. Take care and Jai Hind.